P2P and cryptocurrency. Cryptocurrency stirred the whole world with their emergence after the well-known global financial crisis of 2008, which exposed all the problems of the existing system and significantly shaken trust in traditional currencies, and in general the state as a reliable regulator of the financial market. All this paved the way for the search for alternative solutions, which resulted in an independent and self-regulated cryptocurrency. These days, there's an ongoing debate about the risks to which the owners of this new currency are exposing their fortunes. Many experts, including world-renowned investor and businessman Warren Buffett, openly call for staying away from cryptocurrencies and consider them nothing more than a bubble. At the same time, the market for limited issued assets, namely cryptocurrencies, is steadily growing and attracting more and more investors. Even in the crisis of 2020, despite pandemic restrictions, cryptocurrencies have risen markedly in value. For example, Bitcoin has managed to double in value. The number of active cryptocurrencies is in the thousands, and the total market capitalization today, according to CoinMarketCap, is confidently approaching $2 trillion. These figures can speak both in favor of supporters and in favor of ardent opponents of cryptocurrencies, because, on the one hand, the mentioned figures inspire confidence in everyone who joins the club of new currency owners, but on the other hand, they can only indicate the scale of this very bubble, or, if you will, pyramid. If you have already decided to join this club, then you immediately face the question of how to do it correctly and with the greatest benefit to themselves. One of the most effective tools today are P2P, or person-to-person, peer-to-peer platforms, which allow all kinds of transactions with cryptocurrency without the involvement of intermediaries. The main idea of P2P is the distribution of system information is decentralized as possible, only using software and eliminating the human factor. P2P platforms are used not only for buying and selling transactions, but also as a convenient platform for lending. If we add to the advantage of P2P platforms all the advantages of cryptocurrencies as freely circulating and independent of regulation by central banks, we get a very effective tool for financial and investment market. Imagine that you found a P2P platform with which you want to invest, avoiding cryptocurrencies. You like the opportunities it gives, the potential profits, and even the platform itself. But there are many reasons why you can't invest effectively without using cryptocurrency. For example, you might simply live in a country that is currently under global sanctions, or you might not have the currency you need in your bank account. Also very influenced by the factor of banking and investment legislation, which may differ from country to country. What you do in country A may be against the laws of country B. There are also a lot of reasons that have nothing to do with the investor or his money, but can put the investment process on hold. Using cryptocurrency on P2P platforms, on the other hand, gives the investor the ability to lend the borrower wherever they are, as long as you agree on the interest rate for a P2P cryptocurrency loan. It does not matter where your borrower lives or what currency is in his bank account. In this case, P2P cryptocurrency lending literally blurs the boundaries on the map, allowing investments to work even more efficiently because there are no market restrictions. The investor receives his income in cryptocurrency, which he can keep or exchange for any other currency. Diversification of the domestic market and the national currency are the two main reasons why we should all think about investing, albeit in the still unfamiliar but fast-growing cryptocurrency market. First, let's understand the concept of blockchain, which is the basis of P2P transactions and without which they simply would not be possible. The essence of this technology is that the information about the transaction is recorded in consecutive blocks, and this process is completely carried out by the software, where all authorized users have full access to the entire chain of operations in real time. This makes it possible to avoid mistakes and fraudulent actions at all stages of the system. You should agree that this already causes a high level of trust. Public blockchain, like Bitcoin, does not rely on people or trust. In their work, blockchain nodes confirm transactions and verify that the sender has the cryptocurrency to send to the recipient. Information about each transaction goes to a block, and each block makes up part of the chain. It is almost impossible to change the data inside a block when it becomes part of a chain. This quality of immutability is one of the best features of blockchain. The data is securely stored for historical records or criminal judicial proceedings. Another big advantage is that the user does not have to wait for transaction approval from, for example, Visa, PayPal, or his bank. No one can prohibit you from making transactions with other users using cryptocurrencies as long as you have money in your balance. Blockchain is decentralized, and it is also resistant to unreasonable system rejections when you are rejected because your transaction seems suspicious to the bank. Let's break this down to the main difference between P2P transactions and traditional banking. Data transparency. Anyone can log in and see any transaction at any time on the blockchain. Any P2P crypto platform will have a lot of statistics and information to share with you as a potential lender. An interesting and important fact is that many crypto platforms are regularly audited to confirm their own reserves and overall financial health. Having a common unit of account for transactions also plays in favor of P2P platforms, which reduces or remotely removes all costs associated with currency exchange and additional commissions. When you lend cryptocurrency, you are lending one of three options: Bitcoin, Ethereum, or Litecoin, known as Tier 1 networks. A BTC, ETH, or LTC propriety token is a token that runs on the corresponding blockchain. This variant is mostly similar to the money created by the central bank. Stablecoins such as USDC, DAI, or USDT are focused on price stability. Lending or borrowing them is similar to working in Singapore or Hong Kong dollars. These currencies are not US dollars, but they are pegged to it so that their prices remain constant. Ethereum also has a token standard called ERC-20. Most tokens are based on ERC-20 and are compatible, making them easy to circulate. BTC, or WBTC, and Binance Exchange Token, BNB, are two examples available for lending or borrowing. Lending them out is tantamount to borrowing with assets of known value, such as a work of art, wine, or stamps. There's a certain market for these assets, and they have value, but they are not money in themselves. They are neither a unit of account nor a medium of exchange. Secure lending. The idea behind cryptocurrency P2P lending is that any user can lend to any borrower. And how, you ask, do platforms do this? In two ways: cryptocurrency and collateral. We have already discussed the cryptocurrency part, because there are assets that we borrow and pay back. But lending to a cross-national borrower, who may be in England, Denmark, the United States, Argentina, or China, presents a problem. The only way to protect creditors coming from such different economic and credit systems is through collateral. Every loan on the cryptocurrency P2P lending platform has excess collateral. This means that for every 100 you borrow, you have to post and secure a deposit on the platform for 120, 150, or even 200. But why would anybody want to borrow money this way? The reason could include personal needs, or you don't want to sell your cryptocurrency for cash because you want to keep it for a long time and believe its value will invariably grow. Using smart contracts. On P2P platforms, smart contracts play a key role in protecting lenders. A smart contract is a self-executing contract, with technology enforcing it for you. The algorithm automatically enforces the terms, returning your collateral to you and accepting collateral from the borrower. Liquidity pools for cryptocurrency lending. Another big difference with cryptocurrency lending compared to fiat money is that you can bypass the entire P2P lending process if you wish. You can invest your cryptocurrency in a liquidity pool that lends your money at a fixed rate to any borrower who provides the necessary collateral. This method is simple, quick, and your money starts working right away. You don't have to wait to find your perfect borrower. Now let's look at some of the P2P platforms themselves. P2P cryptocurrency platforms. In most cases, you can't invest and earn interest directly using fiat or traditional money on P2P platforms. You will need to convert your national currency into cryptocurrency on an exchange. One example of an exchange where you can easily convert dollars or, for example, euros into cryptocurrency is Coinbase. In order to take out a loan on a cryptocurrency lending platform, you must own a commonly accepted cryptocurrency to use as collateral for the loan. You will need an approved asset to borrow or lend on these platforms. MyConstant. MyConstant launched as a stablecoin project, CONST, in January 2019, launching the dollar-backed digital currency at CES 2019, a big tech event in Las Vegas. In May 2019, MyConstant launched its cryptocurrency lending platform. It aims to solve the main problems of the traditional economic system. To solve these problems, the MyConstant team has outlined its work in two main areas: giving investors control over the amounts, rates, and terms, and providing all loans with collateral to protect investors' funds. This avoids human error in credit checks and risk assessments. As an investor on the MyConstant platform, you have two options: Flex and Crypto P2P lending. The best option depends on what you want more: to control who you lend to, or to earn more interest on certain cryptocurrencies. The Flex option takes advantage of the liquidity pools we mentioned. Your money goes into the pool and is immediately lent without waiting or matching. This option has some big advantages. You can withdraw your money at any time. There are no fees except maybe a fee from your wallet. Scarudo Pay-to-Play program works the same way as other peer-to-peer matching programs in fiat currencies. If you already have cryptocurrency, you can borrow it and earn up to 11% APR depending on which cryptocurrency you receive as payment. All loans are fully collateralized, which is sold if the borrower defaults on payments. The forced sale is written into the smart contract by default. MyConstant allows you to set your own loan term, giving you a choice between terms of 1, 3, and 6 months. Coin loan. CoinLoan was founded in 2017 by Alex Felushin and Max Sapilov as a platform for loans secured by digital assets. In March 2020, CoinLoan began offering loans from fiat currency to cryptocurrency, and the option of using both fiat and stablecoins as collateral. CoinLoan's investment product is in the CoinLoan interest account, which promises interest income of up to 12.3% per annum. Interest is accrued daily in the currency of your deposit, starting from the moment you deposit your funds, plus the advantage is that you can withdraw them at any time convenient for you. You do not pay a fee for deposits or withdrawals in euros and stable coins. Transactions at CoinLoan work similarly to a bank. They use part of your deposit to create credit offers, and only in the form of cryptocurrency lending. The entry barrier is also relatively low. You can enter with a minimum deposit of about $100. You can maximize your profits with CLT, CoinLoan's service token. Keep in mind that stakes are important for the crypto economy, but not important if all you want to do is lend and make money. BlockFi. BlockFi was founded in 2017 with the goal of giving cryptocurrency holders more options with their digital assets. Unlike many other cryptocurrency lending companies, all of BlockFi's funding came from industrial investors, not from ICOs, initial coin offerings. BlockFi currently offers cryptocurrency holders two financial products: an interest-only account, where you lend your cryptocurrency for compound interest, and crypto loans, where you can raise funds using your cryptocurrency as collateral. To generate interest, BlockFi lends assets held in interest-bearing accounts to corporate and trusted institutional borrowers. These usually take the form of over-collateralized loans. What makes BlockFi special is that the company uses a centralized lending business model, so they are a crypto version of a lender. It is nice to note that BlockFi places clients' funds in a capital structure in such a way that the company itself would incur losses before any client would in the event of default. This creates a favorable incentive system in which both BlockFi and its clients are always interested in controlling the risks of the loans issued. To summarize, we would like to note that these are just some of the most well-known platforms that allow P2P transactions in the cryptocurrency market. Undoubtedly, cryptocurrency today is one of the fastest-growing and most promising financial instruments, which opens almost unlimited opportunities for its owners. P2P, in turn, reflects the global trend towards decentralization and limiting the role of traditional financial institutions such as banks and traditional exchanges.